we're going to look into how the partnership structure will affect the deal, whether like what you're going to charge, whether it's acquisition fee, a disposition fee. Are you going to have a 70-30 split? We're going to look at how that affects our deals.
Yeah, so I just pulled up the analyzer template that we'll be looking at a lot more detail in the coming sections. But just know kind of for now that this template just calculates everything. So everything we've been talking about as far as the deal splits, the net operating income, you can plug it all in this template to calculate your returns at the end of the day. So that's the tab I'm on right now, is the investment returns tab. So you can see for this property that we're looking at, the total IRR, internal rate of return, that is calculated based off of all the inputs right now is 14.6%. The total investor return over the hold period is 104%, 105 almost. And the average cash on cash return is 9.5%. So actually it looks like a pretty interesting deal. Now let's see.
Real quick. That total hold period, right, for this specific deal, you can see on the top corner is going to be a 6-year investor return highlight. So it's a 6-year hold.
Yeah. So yeah, over 6 years, you'll essentially double your money, and you'll make about 14.6% on average as a compounded rate of return. But let's see what happens, right? Because we've been talking about these fees and these splits. Let's see. Let's kind of play around with these rates, and you guys can just see exactly how that impacts our returns. So these fees will be entered on the property and equity details. So going back here, we see all the information that we're saying about the property, and including, the acquisition fee, member equity, a preferred return, an asset management fee. So these are all the fees we've been talking about, as well as the equity split. So in this scenario, the member equities here, the LPs own 70% of the deal, right? So what do you think? What's going to happen if we change that, right? If we change that to an 80-20 split, right? If we say the LPs now get 80% of the deal, what happens to the returns? So let's make that change, all right? So what happened? The investor internal rate of return went up. The investor total return went up. The investor cash on cash, they all went up. Why? Because they own a bigger chunk of the deal, right? They went from 70% of the deal to 80% of the deal. So you can see right there, when you bump up the limited partner, the investor equity, they're going to make more money off the deal because they own a larger chunk of the cash flow coming off the deal. So and it goes vice versa, right? So say we drop it down, right? We go back to maybe we do a good negotiation and get them down to 65%, right? Something like that. That's gonna hit their returns. They don't own as big of a slice of the pie, right? They go down to 14.99 and 9.3. So you can see how
it's showing as 14.1 on my end, Brian, as the investor IRR.
Yes, 14.1. Yep.
Yeah.
I mentally rounded that down to 14.
Yeah.
So yeah, okay. So I mean that's not the only thing. Everything you do, if you start tweaking these percentages, will have an impact on the returns, right? So acquisition fee, 1% versus 2% versus 3%, right? So let's just say the acquisition fee we build into this thing is 4%. So it's just a higher fee off the closing of the investment for the sponsors. All right, you can see that did drop your return as well. So now we're only making 13.3%, 92.6% total, and 8.9% average cash on cash, right? So you can see when you start to increase these fees, you don't want to load up these deals with too much fees to the point where they start to drag down the investor returns, because then it's just going to be a less interesting deal for the investors. Let's see, what else should we play around with here?
We have the asset management fee, Brian.
Asset management, yeah, it's another one right here. Now this one is not a single one-time hit, but this is going to be an annual fee that asset managers get every year. So every year, it's going to be paid out for the ongoing management and oversight of the property. So let's say we increase that to 4%. It's going to hit the returns again. Yeah, now we're down to 12.8, 89.4, and 8.4. So the more fees we keep adding on here, you can see, the less the returns get. And that's, that's kind of how it goes. Right. So, yeah, it's a balancing act, really. You want to make sure the deal is attractive, but you also want to make sure that the sponsorship team, the GPs have to be compensated. There's got to be skin in the game for them. They need to be appropriately, get an appropriate return for all the hard work they're putting in. So it's a balancing act, and hopefully, as you're building these deals out, you can build a good structure that kind of aligns everyone's interests, right? And gets everyone on the same page to go out and make money with this property.
Yeah, I totally agree with that, Brian, because at the end of the day, the passive investor wants the general partner or the main sponsor to make money, because they know if the general partner makes money, then the passive investor will make money as well, right? And vice versa. The general partner wants the passive investor to make money, because they know that if they do make money for that passive investor, then that passive investor is going to invest with them again and again and again. And that's what this game is about building long-term relationships with people and your investors.